Welcome to this month's XPS Investment Update, keeping you informed of key developments and how they may affect your scheme. January saw the FTSE All-World Index deliver its third consecutive month of strong growth, largely thanks to US stocks, which benefited from a technology rally after a more subdued start to the month. However, regional performance around the globe was inconsistent, and UK equities were unable to reach positive territory, despite a rally in the second half of the month. Emerging market equities performed particularly poorly, as China continued to underperform. Investor confidence in China's growth prospects has been waning for some time, and a further blow was dealt in January when indebted property giant Evergrande was formally ordered into liquidation. UK interest rates were held at 5.25% in early February, and the UK Consumer Price Index now stands at 4%, compared to its peak of 11.1% in October 2022. The Bank of England cautioned that more evidence is needed to demonstrate that inflation will continue to fall before interest rate cuts would be seriously considered. UK corporate bonds delivered negative performance despite a modest tightening in credit spreads, but high-yield bonds finished up thanks to more encouraging data over the month to suggest that inflation, especially in the US, was continuing to move in the right direction. Long-term gilt yields rose sharply as investors curbed their optimism over the potential for significant interest rate cuts in the UK over 2024. This resulted in fixed interest and index-linked gilts performing poorly, and the recent volatility experienced in gilt markets is expected to persist. Aggregate UK DB pension scheme funding on a low-risk basis rose over the month as rising gilt yields reduced liabilities by more than assets. The sharp improvement in funding over January largely offset the deterioration seen over the fourth quarter of 2023. That's it for this month's update. For more information, please contact us.